how do you improve something unless you track it? Whether it is your health, that means your fitness habit, your let's say if you are trying to eat right, if you are trying to improve your relationship, if you are trying to improve your career, and finally if you are trying to improve your finances, everything has to be there has to be a measurable progress in so that you can measure that where you are today and where you want to be and how far you have reached along that journey. Now, in case of certain things like relationships, probably it is not so easy or it is not so tangible. But for everything else, whether you are being assessed by your manager at your work, or you are seeing your health, there is always a metric system that kind of keeps track of how much you have improved or what are your current statistics, things like that. And so in case of finances also, there are many different ratios and things like that are applied to fundamental analysis when we look at, let's say, a stock or when we are evaluating a company. But very few times such a thing is applied to personal finances, because personal finances are something that for most people, it just goes along with the flow. They are just earning money, and as long as they are spending less than they are earning, then there is little cause of concern, or sometimes we don't even realize that there is a kind of set of concern that is brewing until there is a time of an emergency or some kind of an unpleasant incident, like losing a job, or let's say running into a difficult medical situation or a divorce or things like that. Until that time, you don't realize that what state your personal finances are. And had there been a very clear metrics that you were tracking almost regularly, and regularly does not mean that you will track it daily, but maybe you would be able to track it monthly, 6 monthly, or maybe once a year only. So in this video, we are going to look at very simple 5 metrics that will define how your finances are doing. And if you measure these 5 metrics and be able to stay within the ballpark of what is considered to be a good financial situation, then it gives you a way to look at your finances today. And if some of the metrics are not up to the mark, then you can take the right actions, you can take the right or make the right changes in your financial life that will actually improve those metrics. So let's dive down into the different metrics. And as I said, there are 5 metrics. So I will start with the simplest one, which is called a net worth. And net worth is something that a lot of people understand, but I have also talked to a lot of people who are very smart in other fields or other things, and they really haven't thought about their net worth. And sometimes there are a lot of misconceptions about net worth also. Now, before I go into all the different aspects of net worth, let me explain what net worth is, in case you already don't know about that. So net worth is really what you own minus what you owe. And this is very similar to the equity of a company, where you subtract the liabilities from the assets, and that gives you the shareholders' equity or the owner's equity. The same applies to your personal life. So for example, if you have $10,000 in your bank, but if you have $5,000 of credit card debt, and I'm just taking a very simplistic assumption that you don't own any other possessions, in that case, your net worth will be $5,000 positive. On the other hand, if you have only $1,000 in the bank but $10,000 of credit card debt, then in a way your net worth is minus $9,000. That means you are in the red in terms of your net worth. That means you don't own anything tangibly after paying off your liabilities. And in fact, with a negative net worth, you will not be even able to pay off all your liabilities. And now I hope you can already start to see why net worth is a very important metric, because it shows you that if you have worked for a certain number of years, if you have earned certain amount of money, then how much did you actually keep with yourself? Now remember one thing, wealth is not built by a high income or a status or working on some like in some big multinational company. Wealth is built by patiently keeping the money that you can keep. That means spending less than what you earn and then saving and investing that difference. And that is what starts building your net worth. Now, as I said in the beginning, there are a lot of misconceptions about net worth. Sometimes there is a continuous debate about whether if you bought a home and that home appreciated, should you include the home equity in your net worth or not. And for most financial advisors, or for most kind of examples in net worth, I've seen that the home is also included in that. Now, nothing wrong in that. It all depends on how you want to measure your net worth and how you want to see that. Now, of course, when you own a home, you may also have a mortgage with it. So really what your home equity is the home value at any point in time minus the outstanding mortgage balance. That's your home equity. Now, this is tracked by many people, sometimes with your even your lenders will ask or find that out if they have to refinance the loan, or if they have to give you let's say a home equity line of credit. Then they want to make sure that you have at least 20% equity left in the loan, or in other words, the loan to value ratio should not be more than 80%. So that way, home equity is also kind of a net worth for your home. So whatever portion of the home that you own, like free and clear, that portion is your net worth. Now, as you can see, this can become volatile also with the real estate market or the real estate values going up and down, and with the current interest environment, like there are sometimes interest rates are going up and then there are talks about it is coming down. Recently the Fed had cut the interest rates, so no one really knows what is going to happen, and home prices will remain volatile for some time. So determining the home equity can be very, very tricky. And so I would kind of suggest that keep your home equity aside, but look at all your other investments and all your other debts, and don't count that home mortgage. And then when you do a subtraction between all your assets that you own minus all the debts that you have, then you will get your true net worth. And this net worth is really your investable net worth. That means this is not consisting of something that you are living in. That means since you did not count your home, so it is really a net worth that you can control. It's not something, for example, if you are living in the home, then of course you cannot access the home equity unless you take something like a home equity loan, which has its own pros and cons. So this is really what net worth is. Now, once you decide the net worth, find out the net worth, a very interesting thing to see is that keeping your home aside, do you have a positive net worth or not? For example, you may have a home equity of $100,000, but let's say you have very little liquid savings, but you also have $25,000 of credit card debt. Now, taking your home equity and everything, yes, you will show a positive net worth. But when you keep your home aside and just take that $25,000 credit card debt and subtract it from rest of your assets, which is just a meager $1,000, then what you have is a negative net worth. So really, even though you are the owner of a home and you have a lot of home equity, but really the usable equity, the usable net worth is actually in the red. That means you are not positive net worth if you do not consider your home. So that is a very important thing to see. And that directly brings us to the next one. That means, what is your quick ratio? Now, quick ratio means it is a way to measure the liquidity in your finances. That means you have some short-term obligations. For example, you have to pay your year-end taxes, you may have to pay your insurance bills, you have other expenses. So when you take the amount of savings or the money that you have lying in the bank and divided by these short-term obligations, that tells you that whether the current money that you have in the bank is going to cover all your short-term obligations or not. And if it does not cover it, then of course that quick ratio will be less than 1.0. And this is a very important element in case of fundamental analysis of companies. Also, we see how solvent that company is. Is it going to be able to pay off all its debt obligations in the short term within the next 1 year or so? And sometimes the receive, like what you count in that is not only cash in the bank, but the amount of money that they are expecting from their customers in the next few months or so. So which are typically called receivables, or let's say, yeah, it's kind of receivables. That means you have made the sale, but you have not yet you had got the money. Now, in case of if you are doing it for your personal finances and you are kind of paycheck to paycheck, or you are depending on your future months paychecks to meet all those short-term obligations, then in a way you can also count those future paychecks as long as you know that they are more or less guaranteed. And in kind of, you're not in a situation where your job is very insecure and you don't even know whether you are going to be with the company for the next 3 months or so. In that case, of course, you cannot count all those future cash flows. But otherwise, for a very short term, for the rest of the year, maybe you can count those future cash flows, and then subtract out your living expenses and see if the rest of them will be able to cover all your debt payments, all your like throughout the year, which does not happen monthly, but you need to save for those expenses anyways, and you have to pay them by end of the year. And these are typically insurances, property taxes, and maybe you have other obligations too. So that is quick ratio, and try to have this quick ratio above 1 so that you have enough liquidity in your finances to be able to cover all your short-term obligations. The next one is the debt to equity ratio. Now, we have talked about equity or net worth. Now the question is that why is debt to equity ratio important? Because we have got that equity by subtracting our liabilities from the assets. Now we are again putting those liabilities or the debt on top of the net worth and trying to do a ratio. And the reason we want to do this is that if we can keep this ratio below 1, which means that taking our current net worth, that we can any day take our liquid assets and be able to pay off all our debts. And this is very important, because when you are able to do this, that means you have at least twice the amount of net worth or twice the amount of assets than your debt. So that way, even after you pay off all your debts one fine morning, you will still be left with some assets. Now, if your net worth is very close to zero or just marginally higher than your debt, so that means if the worst comes to worst, then your assets will be liquidated and all your debts will be paid off, but then you will be left with a very little net worth. So having a very low debt to equity ratio means you have a large amount of equity compared to your debt. That means after you pay off the debt, you will still be financially okay. The fourth one, which is a very common one, and there is another name for this is called an emergency fund. Now you will hear a lot of financial experts talk about having a 3 months, 6 months of emergency funds, but you can also consider it as another ratio or a metric. And the way to look at that is, look at your current liquid savings, not your investments, but your liquid savings in your checking savings account or CDs, and divide that by the total monthly expenses, including your monthly debt payments. That means car payments, any monthly credit card payments you are making. And if that number is greater than 3 or 6 or whatever you are comfortable with as an emergency fund, that should be a metric for you to measure. That means today you may not have enough liquid savings, but if this ratio is very low or maybe close to 1 or even less than 1, then your goal should be to increase it to whatever amount, at least 3 months, if not 6 months or more. And the more you put that basically puts you into a better financial situation. It makes your finances more resilient to unknown events or unexpected events like COVID or 2008 financial crisis and so on. So those were the 4 ones that we have talked about, the positive, whether your net worth is positive or negative without considering your home. The second was the quick ratio. That means your current liquid investments, are they enough to cover your short-term debt obligations or not? Then we talked about debt to equity ratio. That means your remaining equity or your net worth, is it more than your debt or not? And if it is more than your debt, that means you will be able to comfortably take care of the debt, and in a way you have chosen not to pay off that debt. You have the assets to pay off that debt. The fourth one was the emergency coverage ratio, or the emergency fund as it is popularly known. And that leaves us with the last one, and this is very, very important. This says that how you are running your finances, how much you are controlling your spending, and how much you are really aware of your finances, because a lot of people are not able to save enough money at the end of the month. And this is something I described it as the concept of an idea by which money flows in most people's lives. So idea stands for income, debt, expenses, and assets. So what happens is the income comes at the beginning of the month, or maybe twice a month. And then you pay your debt payments, your car loan payments, maybe you have credit card debt or your home mortgage, all those things, and even taxes can be considered as some form of a debt. So once you make those debt payments from your income, the next thing is you will go ahead and enjoy and live your life, and you will pay your bills, you will make your lifestyle expenses, and so on. And that's the E part of the idea. And then finally, if anything is left over, that will go towards savings or your assets. And when we measure this, how much portion is finally remaining out of your income, this is really the savings ratio. So for example, if you are earning, let's say $10,000 a month, which is after all taxes and deductions, and if you are left over with only $100 at the end of the month, then your savings ratio is kind of 1%. And for some people, it's even lesser than that, or worse, that some people will not have anything left over at the end of the month, and they will rely on the rolling of credit card debt, and which means they are already spending more than they are bringing in. So make sure that you have a healthy savings ratio. You can start off with even 5%, 10%, and then increase it up to 20 to 30%. So it depends on rest of your financial picture, that how much savings ratio you should target for. If you already have a lot of assets, and as we said, that if you have a good amount of net worth, if you have a good quick ratio, if your debt to equity ratio is really low, and if you have good emergency coverage, then maybe you can get by with less savings ratio, because maybe you are towards the end of your career, or where you have already accumulated a lot of assets and you are just preparing to retire. So you are getting out of that accumulation phase, and now you will basically spend your assets and live your life in a semi-retired mode. But if you are in the beginning of your career where you do not have a lot of assets, your net worth is still building up, that is the time where this savings ratio can actually give a power lift to your net worth. It can give a power. The more money you save, you can either direct it towards your emergency coverage to improve your emergency coverage. You can direct it to build your more net worth, which means your debt to equity ratio will improve, assuming that you don't take up more debt. And then you may also keep some of the funds liquid to improve your quick ratio. So those are the 5 areas or the 5 metrics that if you continuously monitor in your finances, you will know where to send your next paycheck, or how much to save, and how to utilize any windfall. Maybe at the end of the year you get a bonus, and now if you look at those 5 ratios and you say that, okay, in the first 4, what can I improve? Should I improve my net worth? And if you see that yes, all of them are in great shape, maybe you can give yourself a permission to enjoy that money and spend it on something nice that you would like. But if not, if you identify that yes, 1 or 2 areas are still not up to the mark, maybe a part of that money should be channelized to make that better. And that's how you can do a good financial management, and that's how you improve your finances. You go from where you are today to a place of financial abundance where you want to go. And if you really like to know of a more goal-driven process of how to improve your financial life, then I have an ebook, the link for which I will put in the description below. So you can download that ebook, and that will give you my 4-step process of how to go from your current financial state to a financial state that you want to achieve, or you have some goals, and you can actually put those goals into that 4-step framework, and it will help you achieve whatever financial goals you have. So hope you like this video. Please subscribe to my channel. That way YouTube will show people like you more of these personal finance videos that I have been bringing. And sure, talk to you till the Talk to you in the next video. Thank you.